Constance, tell us your initial reaction. Big beat of the expectations on the number of jobs created. A little bit of a downward revision for last month.
Right. So what I would do is I take the smooth number of the 2 months. It's about 180,000, and say that that's right where we have been adding jobs over the past year and a half. It's a slightly slower rate, and really the thing to look at is that wage number, and then digging into which sectors were the sectors that caused an increase in wages.
So one of the things that, just looking at the breakdown here, manufacturing was up 32,000 jobs, which is much above the last several months. So it looks like there's a big gain in manufacturing, for example. Right.
Well, I'm sure that there was a pullback in September as well, right? So, and I don't know what the revision, I'm not looking at the detail yet, but I don't know what the revision was in September, but it's looking at those 2 months, or really August, September, October together, and figuring out what's going on. We like to compare against the 6-month average to see what the trend is compared to that.
Subadra, where do you short?
Yep, I think that the market's reacting exactly the way I thought it would, in the fact that we've got a strong headline number. People are going to be willing to look past weakness in the September report, September revisions, and you also got a wage number year over year. Average hourly earnings were above 3%. So that's, to me, is a very important psychological level, and that I think is what's going to support higher yields over the near term.
Where on the curve is going to see the most re-rating?
It's going to be from the belly of the curve, because the front end is pegged to Fed expectations. So if there's any sort of positive news on the economic front or the fundamentals, you're going to see a sell-off led by the belly.
Okay, Jane Foley of Rabobank, let's give us a view into FX. You said if there were weak numbers, it would affect the dollar. How are these numbers affecting the dollar?
Well, I think, almost irrespective of how you deep down into these numbers, the headline suggests that the Fed is likely to push ahead with its interest rate hike in Q4. I don't think very many people would really argue with that from the numbers that we've just seen. And that, of course, reaffirms the dollar's strength, if you like. So we do have a view that the dollar will continue to firm over the next 4 or 5 months or so. But I think the market still needs to know what's going to happen with that trade pact. And I think that's where a lot of the attention is going to be in the next few weeks. So, yes, this is a dollar positive story, but a lot of the dollar positive implications of the Fed are already in the price. And I think attention is swiftly going to turn next week back to what's going to happen between China and the US on trade.
And fair point. I want to get in here too, because there was a trade gap that was also reported that I want to get into. Basically, the trade gap was a 7-month high, but both exports and imports increased. Soybean exports, though, if we want to look on a trade level, we're down 29% month on month. That's the lowest since February. So definitely an impact on the trade front. But those numbers are actually really good. I mean, Subadra, you have higher exports, higher imports. Like, all that seems to be a good thing. Can we handle higher rates in the economy if it's because we have solid growth?
Absolutely. I think that if the repricing to higher yield levels is gradual, I think the market can easily handle higher yields. You're seeing a lot of strength. I mean, especially on the employment front, like we saw today, is going to support a strong consumer. So, to me, that's the key. And, you know, as we know, a good portion of the U.S. GDP is the consumer. So as long as employment is strong, you're going to see a strong consumer, and we should be able to support higher yields on the back of that.